The stock market just hit record highs. The S&P 500 is up around 11% this year, near an all-time peak. By that measure, America is thriving. And yet, survey after survey shows people feel as gloomy about the economy as they have since just after the pandemic, stressed about the cost of everything. So which is it? Is the economy booming, or is everyone secretly broke? The answer is both, and understanding why explains one of the most important and least talked about truths about how money actually works in this country. Let's start with the obvious question: how can the stock market soar while regular people feel poorer? The first answer is the big one, and it's a number that reframes everything. The stock market going up makes headlines sound like good news for everyone. But look at who actually owns the stocks. The wealthiest 10% of Americans own roughly 87 to 93% of all stock market wealth. Let that sink in. The top 1% alone hold more stock than the entire bottom 90% of the country combined. So when the news says the market hit a record, it's technically true, but the gains flow overwhelmingly to people who were already wealthy. For most Americans, a record-high S&P 500 is a headline about someone else's money. Now here's the second piece, and it's what people actually feel every day: the difference between the rate of inflation and the level of prices. Politicians love to announce that inflation is coming down. And it's true, the rate of price increases has slowed, from over 9% at its peak to under 3% now. But here's the trick that fools everyone. Inflation slowing down does not mean prices went down. It means they're rising more slowly. The price increases from the last few years didn't reverse, they stacked, and they stayed. So your groceries, your rent, your insurance are all still dramatically more expensive than they were a few years ago. When an economist cheers that inflation cooled, your brain hears things got cheaper, but your wallet knows they absolutely did not. That gap between the official good news and your lived reality is a huge part of why everyone feels broke. Which leads to the third factor: wages versus prices, and the timing of the race between them. Over the past few years, prices sprinted ahead first, fast. Wages did eventually rise too, but they chased from behind, and for a long stretch, prices were winning. Even when your paycheck finally goes up, if the cost of living rose faster or got there first, you're running just to stay in place. And there's a psychological cruelty to it. People tend to feel that a pay raise is something they earned and deserved, while a price increase feels like something being done to them. So even when the numbers roughly even out, the experience feels like a loss. You credit yourself for the raise and blame the world for the prices. There's even a name that emerged for this whole disconnect: the vibecession. A recession in how people feel, even while the official statistics say things are fine. And here's the honest, uncomfortable nuance, because this channel doesn't do simple villains. Both sides are telling a kind of truth. The economists pointing at record markets, low unemployment, and cooling inflation aren't lying, those numbers are real. And the person staring at a grocery receipt feeling poorer isn't imagining it, that's real too. The mistake is thinking one of them has to be wrong. They're measuring different things. The statistics measure the economy in aggregate. You experience it as one specific person, with one specific budget, in one specific place. A national average can look wonderful while your particular slice of it feels terrible. So what do you actually do with this? A few honest takeaways. First, stop letting stock market headlines define how you should feel about your own finances. That record high is largely disconnected from your daily reality unless you own significant assets. Second, understand the inflation trick, so you're never fooled by inflation is down into thinking relief has arrived. The relief only comes if prices actually fall or your income outpaces them. And third, the empowering one: this is the strongest possible argument for becoming an owner of assets, not just an earner of wages. The reason the wealthy pulled away is that they owned the things that went up while everyone else only held the cash that bought less. You don't need to be rich to start owning a slice of that. Even small, consistent investing over time is how ordinary people stop being purely on the losing side of this equation. So, why does everyone feel broke while the market hits record highs? Because the market isn't the economy. The gains belong mostly to people who were already wealthy. Prices stacked up and never came back down, and your paycheck has been chasing them from behind. You're not crazy, and you're not bad with money. You're feeling a real, structural gap that the cheerful headlines conveniently skip over. The best response isn't despair, it's understanding the game clearly enough to slowly move yourself onto the ownership side of it. This is educational, not financial advice. Always do your own research. If you want the honest version of stories like this, subscribe.